Welcome to Capitalism That Works, a joint production by GlobalTreehouse and Jesper Koll. And in today's session, we want to talk about corporate realities, the new Japan Inc. Now, when you talk about the corporate sector of Japan, there's obviously lots of individual anecdotal evidence that you may find interesting. Whether it is, what Toyota is doing in electric cars, whether it is the new venture capital scene that is developing in Japan. But for this session, I want you to focus on the key macro drivers that are actually dictating what is going on here in Japan. And first, I want to talk about the domestic forces that have changed. And then, second, want to talk a little bit about the global forces that have changed for corporate Japan. And we want to demonstrate how apt corporate Japan has actually been at adapting to the global realities, which is why I think Japan is capitalism that works. So let's start with the most important question you always should ask yourself when you look at a company or when you look at the stock market or when you look at an economy, which is who actually owns the corporations? And in Japan, the answer used to be very simple. Japan was owned by the Japanese, specifically was owned by the corporate clubs, the Keirestsu clubs, like the Mitsubishi Group, the Sumitomo Group, the Mitsui Group. And you can show that by the end of 1989, 50% of the ownership was tied up in the cross-shareholdings, those ownership within the big industrial groups. Now, looking at Japan today, the big change is that this is no longer true. The cross-shareholdings have come down from 50% to barely 4%. And as a result of that, you see that corporate Japan has actually opened up. This is very important. It used to be a club-type system. If you were not a member of the Mitsubishi Group or the Sumitomo Group or the Mitsui Group, you did not have access to good information or corporate strategy. That was cemented by the cross-shareholdings. Now that these have come down, corporate Japan is much more of an open system, and the individual companies are indeed governed in a much better way and are actually communicating with their shareholders, with their business partners in a much more open and free market way. So the bottom line is, corporate Japan used to be a closed club-type system, while now it is an open, free market system. Now then, when you focus after the ownership on the actual performance, what you do see is that yes, corporate Japan has actually been able to increase performance. If you look at earnings per shares, if you look at return on equity, in the last 30 years, there's been a steady up move, right, in the return on capital, in the return on equity. But what is interesting is that the return on equity, the return on capital, yes, has improved, but it is still lagging behind what we have in the United States. I mean, as you probably know, in the United States, the sort of average historic return on equity, is around 14-15%. In Japan, it is now between 8 and 9%. So there's still a gap. And the question is, why is that gap? And the big difference is that corporate Japan does not have any superstars. Now, what do I mean by that? If you look at the return on capital, the return on equity, and you compare Japan and the United States of America, what you find is that in Japan, the distribution, so the spread away from the average, away from the mean, is pretty much a normal bell curve type distribution. In the United States, what's interesting is that it's actually not a normal type distribution. It's much flatter than what we have in Japan, but you do find that there are about 12, 13, 14% of American corporations that are absolute superstars in terms of generating high return on equity, high return on capital. So that's the big difference. Why is Japan an underperformer? It is actually simply because corporate Japan does not have, superstars like right now the technology companies that we've got in the United States of America. So that point, I think, is very, very important to actually focus on. Now, then the big question is, why does Japan not have any superstars? And the reason is very straightforward. It is the domestic industrial structure is marked by excessive competition. Now, as a capitalist, you may say, what is he talking about? Excessive competition. Isn't competition always a good thing? Well, that depends. Look at the difference in industrial structure. In the United States, the top 4 firms in the various industries, from steel, pharmacies, telecommunications, airlines, hairdressers, whatever it is, you find in America the top 4 firms control about 33% of the overall revenue stream in their respective industry. In Japan, it's not 33%, it's 11%. So much, much more competition here in the domestic market. And again, we were looking to explain why is it that corporate Japan does not have any superstars. It is because the domestic industrial structure is way more competitive. There are way more players that carve up the various markets. And as a result of that, you can't get these sort of super returns that you get in the United States of America. I believe that this is about to change over the next 5 to 10 years. And the big reason is the demographics of Japan. And that is the domestic industrial structure, of course, is dominated by small and medium-sized enterprises. Japan has about 3.6 million companies. 99% of these are small and medium-sized companies, which means that they employ fewer than 300 people. And when you look at this, at these 3.5 million companies that are small and medium-sized companies, where the owner is over the age of 70, that's now 2.4 million companies. So imagine that. A small and medium-sized company where the owner is over the age of 70, some generational succession is going to be happening. But the point is that according to surveys, no successor available applies for 1.3 million companies of those 2.4 million companies where the CEO or the founder is over the age of 70. So there will have to be, because of the demographics, there will be a big industrial restructuring here in Japan now, and it is very interesting. You actually are beginning to see a big wave of mergers and acquisitions here in the belly of the Japanese economy. And that's what's exciting, and it's interesting to see that the recent government measures are actually using that tailwind from the small and medium-sized companies' succession, to actually foster greater industrial reorganization, because as I mentioned, there is no question that corporate Japan has excessive competition with the top 4 players in each market controlling less than 12%, in their respective industry. There's no way that you can generate a high rate of return with that degree of excessive competition. So, the domestic part of the Japanese economy, number one, the ownership has changed from a club system towards an open system, with the cross-shareholdings having come down. Corporate Japan is open for business. The second driver, you have this natural force allowing for industrial reorganization and streamlining because of the age structure and the succession planning of many of the small and medium-sized enterprises here in Japan. So in other words, from my perspective, corporate Japan is open for business and businesses are available to be bought. That's a wonderful way to actually grab a foothold here in the domestic economy of Japan. Now, what about the global side of the business? And that's obviously not the small and medium-sized companies. The global side of Japan Inc. is the large listed corporations. What is exciting to see is how well they have adapted to the change in the global realities. If you look at the earnings, where does corporate Japan make money? You find that for the listed companies now, 63% of the profits are made from exports or producing overseas. And that is now 63%. 10 years ago, that was about 50%. So it has actually grown. So corporate Japan has actually become more global. Very interestingly, they have restructured their global production map, and it's a much more balanced production map. What do I mean by that? About 10 years ago, half of those overseas profits were dependent on the United States of America. That is down to about 24% now, while in contrast, you find that the People's Republic of China and Asia Pacific has actually grown, and you now find that corporate Japan is no longer lopsidedly dependent on the United States of America, but is much more balanced in terms of where profits, where earnings, where cash flow is actually going to be generated. And this is interesting, and it obviously shows that corporate Japan is in fact extremely global and very well geared and in an excellent position to benefit from the biggest economic upcycle that our generation is going to go through, which is the rise of the middle class here in Asia Pacific. So, in summary, you've got a corporate Japan that is open, no longer dominated by the cross-shareholdings. You've got a corporate Japan that is profitable, but does not have any superstars. But now the domestic economy is going to be restructuring predominantly because of the demographics and the succession of the small and medium-sized enterprises actually being a catalyst for industrial streamlining. And then last but not least, corporate Japan is well diversified in terms of its global exposure. It is now very geared into Asia Pacific and the People's Republic of China, as well as the United States of America. And from that perspective, I think Japan's corporations are actually a model case study on how to build a system of capitalism that works. Thank you very much. I hope you enjoyed this session, and GlobalTreehouse and myself look forward to seeing you at some of the other sessions of our series, Capitalism That Works. Thank you very much.